Hey guys, welcome to another video in this series. This is called The Easiest Way to Get Rich. In step number 3, we're going to take a look at investment accounts and how to choose the right accounts and the right times at which to invest in each of these accounts. Now we're going to be talking mostly about the RRSP, which is also known as the 401k, and we're going to be talking about the tax-free savings account, which is also known as the Roth IRA for those of you that are in the United States. So let's say we have a baseline salary of $70,000, and I'm going to give you incremental tax brackets here on the right side. And incremental income taxes in between each of those brackets. And we're going to look at strategies to maximize those tax returns. So the tax brackets, here they are. And we're going to look at different contributions that you can make to your RRSP and what they would have as an impact on your tax returns. So with a salary of $70,000, you'd be located in that upper tax bracket and paying 40% on that amount that surpasses the $65,000 amount. In between the 50 and 65, you'd be paying 37, and whatever you earn that's lower than 50, you'd be paying 34% on that income. So baseline, you'd be paying about $24,500 in income taxes. With all that being calculated. So if you invest $10,000, then your salary sort of goes down by $10,000, like we talked about in the RRSP video, and you'd be getting a tax return of $3,800. All right, so that's a pretty good tax return. And one thing you can do with that extra cash that you're getting is keeping it for next year and reinvesting it as as a lump sum into your RRSP. So that's sort of an extra free contribution that you're getting, guys. It's sort of free money that you're getting to reinvest next year. Or what you can do is put it in your tax-free savings account and get it to grow in a tax-free fashion. So again, if you haven't seen the tax-free savings account video, go check that out. So that's a pretty good return, guys. $10,000 in investment, you're getting almost $4,000 back, which you can then put straight up again next year into your RRSP. So we'll take another look here at a sort of a different example. Let's say you really want to buckle down on investments, and you manage to scrape up some money, and you invest a lot of money into your RRSP. Let's say, for example, here $19,500. Okay, you gather all that money and you're able to put that all that money into your RRSP. Your tax return would now be of over $7,000, guys. That's incredible. And you're saying, well, what else can I do to keep getting that tax return to go up? Well, like I said, you scraped up all that money. You managed to find $19,500, but you don't have any more money from your income coming in. You can take money from your tax-free savings account and transfer it into your RRSP, and that's going to count as a contribution as well. Let's say you transfer an additional $1,000. Your tax return would now go up to almost $8,000, just under $8,000. So you can see here how even transferring from one account to another can be very, very beneficial as well from a tax point of view. Now with that $7,700, what you can do is, if you have room in your tax-free savings account, recontribute it to your tax-free savings account. Now, look at the video to know what I mean by if you have extra contribution room, because you can't necessarily just take out money, put it back in right away. There are rules related to that. But if you do have room, you can do that. That's no problem. And one thing you can do as well is keep it, invest it, and then once it comes time to contribute again to next year's RRSP, then you're almost already halfway there with that $8,000 ready to go right back into your RRSP, and you'd be collecting income tax and you'd be collecting tax returns on that extra $8,000 as well, guys. So it's sort of compounding. So guys, I hope this video was useful. It's just a little basic overview of how you can manage to get some good tax returns. Don't forget to like this video, leave a thumbs up, and leave a comment down below.